The letter arrived every April, and you paid it. That was simply how council tax worked. You did not question the number because you assumed the council knew what it was doing. 25 reductions, discounts, and exemptions written into British law, available to pensioners across every local authority in the country. Most councils have never sent you a reminder. The bill sitting in your drawer is almost certainly wrong. Section 1. The wrong band. Every April, the bill arrived, and every April you paid it. The number changed slightly each year, always upward, and you absorbed that change the same way you absorb the price of a loaf of bread going up, with the particular resignation of someone who has learned that these things simply happen and that nobody consults you before they do. The direct debit went out on the first of the month without requiring your attention, which meant that at some point it stopped requiring your attention at all. You stopped reading the bill with any real focus. The number was the number. The council had worked it out. That was what councils did. What the council almost certainly did not tell you is that the number on that bill is based on a guess, not a calculation, not a survey, not a considered assessment of your property carried out by a qualified professional who walked through your rooms and measured your floor space and examined your street. A guess made in 1991 by a valuer who in many cases never got out of the car. When council tax was introduced on the 1993 to replace the deeply unpopular community charge, which the country had spent several furious years calling the poll tax, the government needed to assign every domestic property in England a band from A to H based on what that property would have been worth on 1st April 1991. 8 categories, covering everything from a studio flat in a former mining town to a detached house in the Surrey commuter belt. The Valuation Office Agency was handed approximately 25 million homes and told to get it done before the new tax launched. The timescale was not generous. The method that resulted from that pressure had a name, and the name tells you everything you need to know about how seriously your property was examined. They called it the drive-by. A valuer drove along a street, looked at the houses from the window, made a judgment about the general character of the properties, and assigned the band from the curb. Entire terraces received the same letter, regardless of whether the end house had a larger plot, whether a loft had been converted, whether one property had been extended to the rear while its neighbor had not. The system was built for speed rather than accuracy, and speed is what it achieved. Accuracy was a different matter. An estimated 400,000 homes in England and Scotland are currently believed to be sitting in the wrong band as a direct result of that exercise, and some researchers put the figure considerably higher. The band matters because the band determines how much you pay, and the relationship between bands is fixed by central government, not by your council. Band D is the reference point. Band A, the lowest, pays 6/9 of whatever your council sets as the Band D rate. Band H, the highest, pays 18/9, which is to say exactly double. Move down one band and your annual bill falls by between £200 and £500, depending on where you live. Move down 2 bands and the saving doubles. For a pensioner on a fixed income in 2025, that difference is not incidental. It is several months of energy bills. The mechanism for challenging a wrong band is free. It is not complicated, and the Valuation Office Agency is the body you contact to begin it. What you are looking for is evidence that similar properties on your street or estate sit in a lower band than yours. Properties of the same age, style, size, and design. You are entitled to submit the addresses of up to 5 such properties as part of your challenge. The Valuation Office will consider your evidence and either accept the challenge or decline it. If they accept it, the correction is backdated, not to last year, not to when you first noticed, but to the date you moved into the property, or to 1993, whichever is more recent. Refunds of £1,500 for a short tenancy and £20,000 for a long one are both documented outcomes of this process. The challenge is free. The refund arrives as a credit against your future bills. The one risk worth understanding before you challenge is the same logic running in both directions. If the Valuation Office reviews your band and concludes that neighboring properties you submitted as evidence are themselves undervalued, those neighbors can find their bands moved upward rather than yours moved down. This is uncommon, but it does happen, and it is the reason every piece of guidance on the subject says the same thing. Do not challenge on instinct alone. Check the evidence first. If 3 similar houses on your road are genuinely in a lower band than yours, and the 1991 property values support the case, the challenge is sound. If you are simply hoping the number comes down, without evidence behind the hope, the risk runs the wrong way. England has not revalued its council tax bands since 1991. Wales revalued in 2003. Scotland continues to operate on the 1991 figures. The band applied to your home more than 30 years ago, during a rushed mass valuation exercise, conducted largely from car windows, is the same band you are paying against today. 1 in 4 households that challenge their band succeed. The Valuation Office recorded over 10,000 successful challenges in a single recent year. The letter arrives every April, and you pay it. You have always paid it. The number on it may not be the number you actually owe. That band has been sitting unchanged in a government register since before most smartphones existed, costing you more than it should every single month. But the band is just the beginning. There is another reduction available to any pensioner living alone that councils apply automatically to almost nobody, and it is worth 25% of everything on that bill. Section 2. The single person discount. At some point, the house got quieter. It might have happened gradually, a child moving out for university and then not coming back, or a partner who had always been there and then was not. The rooms were the same rooms. The kitchen was the same kitchen. The bill arrived every April the same as it always had, with the same number at the bottom, give or take a few pounds for that year's increase. Nobody from the council wrote to say that the number had changed. Nobody called to check whether the household had changed. The bill arrived, and you paid it, and the house stayed quiet, and that was how it continued, year after year, while a discount worth 25% of the entire bill sat unclaimed in a system that had always known how to give it to you, and simply waited for you to ask. The single-person discount is the most straightforward reduction in the entire council tax system. If you are the only adult living in your home, you pay 75% of the full bill. The council calculates a full charge on the assumption that 2 adults are resident. 1 adult means the bill falls by a quarter. No income test applies. No means test. No savings threshold. A pensioner with a comfortable private pension and a mortgage-free house is entitled to it in exactly the same way as someone on the lowest income, because the discount is not about what you earn. It is about who lives there. You are the only adult. The bill should reflect that. Those are the only 2 facts the council needs. As of late 2023, the single-person discount was being applied to just under 1/3 of all properties in England. In a single district council in Lincolnshire, covering around 100,000 households, more than 22,000 properties were receiving the discount in the 2022 to 2023 financial year, worth nearly £9 million in support. That figure gives you a sense of the scale of what is at stake, even in a modest-sized area. Applied nationally to a Band D rate of around £2,000 a year, a quarter reduction saves £500 annually. Over 5 years of living alone, without claiming, that is £2,500 that left your account without cause. The most common reason pensioners miss it is the same as the most common reason any household misses it. Circumstances changed and the council was not told. A partner died. A son or daughter who had been on the electoral register at your address moved away. A lodger left. The household shrank to 1 qualifying adult, and the bill did not reflect that, because the council does not monitor your front door. It knows what you tell it, and nothing else. When the circumstances that trigger the discount arrive without an announcement, which is how most of the significant changes in later life tend to arrive, the discount stays unclaimed until someone thinks to ask. The application itself takes minutes. You contact your local council, inform them that you are the sole adult resident, and the discount is applied. Most councils now have an online form. Some will ask you to confirm the change of circumstances in writing. The discount is then applied to your account, and any overpayment, since the point your circumstances changed, is dealt with as a backdated refund, subject to the council's own policy on how far back it will go. There is no fixed legal time limit governing how far back a council can backdate the single-person discount, which means there is also no fixed limit on how much you could recover. Many councils routinely backdate 12 months. Others will go further if you can demonstrate when the qualifying circumstances began. A household that has been paying the full rate for 3 years, following a bereavement, has a legitimate case to make. One additional point that most guidance does not lead with: the discount applies not only when you are the sole adult in the property, but when everyone else in the property is legally disregarded for council tax purposes. A full-time student sharing your home does not count as a second qualifying adult. Neither does someone who qualifies as severely mentally impaired. a category covered in a later section of this list that has its own distinct and very different mechanism. If the only other person in your home falls into one of those disregarded categories, the discount is yours, regardless of the fact that you are not technically alone. The bill on your doormat was written for 2 adults. If only one of them is still there, it was written for a household that no longer exists. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That 25% comes off automatically once you ask for it, and you can ask for it today. But sitting inside the same bill, invisible to most people who qualify, is a reduction with no income test and no application form, one that exists purely because of a condition a doctor has already documented, and that can wipe the bill entirely. Section 3. The severely mentally impaired disregard. The form existed. It had always existed. Your GP had the paperwork, or could produce it without any difficulty, and signing it would cost you nothing, because general practitioners are not permitted to charge for this particular certification. The council had a process for receiving it. The reduction on the other end of that process, once the form was submitted and accepted, was not 10% or 15%, but the entire bill, removed completely, backdated to the date the qualifying condition began. All of that was in place. The law required it. What was not in place, in the majority of councils across England and Scotland, was anyone telling you it existed. The reduction has a name that almost nobody outside the benefits system has heard, and the name itself is part of why it stays hidden. The severely mentally impaired disregard applies to any person diagnosed with a permanent, severe impairment of intelligence and social functioning. That is the legal definition, and it is broad enough to cover a significant number of conditions that affect older people in this country. Dementia in all its forms qualifies. Alzheimer's qualifies. Parkinson's disease at an advanced stage with cognitive involvement qualifies. A severe stroke that has left lasting cognitive impairment qualifies. Huntington's disease qualifies. The label attached to the discount sounds clinical and distant, which may be one reason households that clearly meet the criteria never think to connect the diagnosis their family has been living with to a reduction on a council tax bill. 2 things are required to qualify. A registered medical practitioner, in most cases a GP, must certify in writing that the person meets the definition. That certification is free. The second requirement is that the qualifying person must be entitled to at least one of a list of benefits, which includes attendance allowance, disability living allowance at the higher or middle care rate, personal independence payment at either daily living rate, and several others. Entitled to, not necessarily actively receiving. The distinction matters for households where an application for a qualifying benefit was made, but the financial paperwork was never followed through to the council tax office. What the disregard does in practice depends on who else lives in the home. A person who qualifies and lives alone is removed from the count of adults for council tax purposes entirely. A property with no qualifying adults owes nothing. The bill goes to 0. A person who qualifies and lives with one other adult who does not qualify means the household is treated, for council tax purposes, as a single occupant property, and the single person discount applies at 25%. When both or all residents qualify, a 50% discount is standard, though some councils go further. An investigation conducted and published by a consumer money website in 2017 revealed what the uptake figures actually looked like on the ground. Freedom of Information requests sent to councils covering approximately 20 million households found around 74,000 households claiming the discount nationally. Against an estimated eligible population running into hundreds of thousands, that gap is not a small administrative shortfall. It is a structural failure of communication. The same investigation ran a mystery shopping exercise in which researchers contacted councils directly to ask about the discount. 2/3 of the councils contacted were unable to provide accurate information about how to apply. One Scottish council had 11 households receiving the discount against a total of 57,000 properties in its area. The founder of the website that conducted the research described the result as a postcode lottery and observed that because the discount is funded centrally rather than coming out of the council's own budget, there is no financial incentive for councils to advertise it aggressively. The backdating position is where the real money sits for families who have been living with a qualifying diagnosis for years without knowing the reduction existed. In Wales, the discount can be backdated to the date of diagnosis as a matter of standard practice. In England and Scotland, councils have discretion, and their policies vary considerably. But the correct legal basis for backdating is the date from which the person was both medically certified and entitled to a qualifying benefit. A 94-year-old woman with dementia living alone had her bill reduced to zero and received a refund of £15,400, backdated to when she first began receiving attendance allowance. A family caring for an adult child with cerebral palsy recovered £20,000 after a successful backdating argument that required the family to retrieve old bank statements to prove the qualifying benefit had been in payment since 2007. These are not exceptional cases engineered by specialist advisors. They are the outcomes of an application that required a GP signature, a benefit award letter, and a letter to the council. Your GP cannot charge for the form. The council cannot refuse the discount if the criteria are met. The question is only whether anyone has connected the diagnosis that already exists in a medical record to the bill that arrives every April, as if it were inevitable. That disregard can wipe the bill to nothing, and the GP's signature costs nothing to obtain. But sitting alongside it in the same legislation is a separate reduction for the person who lives with and cares for someone, one that most councils apply to almost nobody, and that works by a completely different mechanism. Section 4. The carer's disregard. You did not fill out a form to become a carer. That is not how it works. It happens gradually and then completely. A morning routine that takes longer than it used to. A hospital appointment that becomes a regular appointment. A level of daily involvement that crosses some invisible line between helping and caring, without any announcement marking the moment it did. By the time you are providing the level of support the legislation has in mind, you have long since stopped thinking of it as a category or a status. You are just doing what needs doing, every day, in the same house, for the same person, and the council tax bill arrives every April the same as it always has, and you pay it the same as you always have, because nobody told you that what you are doing qualifies you to be removed from the bill's calculation entirely. The carer's disregard works on the same principle as the severely mentally impaired disregard covered in the previous section, but through a completely separate mechanism. Certain categories of people are not counted as adults for council tax purposes. When the occupancy count drops, the bill drops with it. A live-in carer who meets the qualifying conditions is one of those categories. If you and the person you care for are the only two adults in the property, and the disregard applies to you, the household is treated as having one adult. The single-person discount follows automatically, 25% off the full bill, applied because the law says the hours you put in and the condition of the person you care for place you outside the count. The conditions are 4, and all 4 must be met. You must provide care for at least 35 hours a week on average. The threshold is weekly, not daily, so irregular care patterns are assessed across the full week rather than against a fixed daily minimum. You must live in the same property as the person you are caring for. You must not be the spouse, civil partner, or unmarried partner of the person you care for, and you must not be the parent of a child under 18 in your care. And the person you are caring for must be in receipt of one of a list of qualifying benefits, which includes attendance allowance, the middle or higher rate of the care component of disability living allowance, and the standard or enhanced rate of the daily living component of personal independence payment, among others. 2 points in that list deserve emphasis, because they are the 2 points most frequently misrepresented on council websites. First, you do not need to be receiving carer's allowance. The carer's disregard and carer's allowance are entirely separate mechanisms with entirely separate qualifying conditions. An adult child caring for a parent, a sibling caring for a sibling, a friend caring for a friend, any of these relationships can qualify for the disregard without any formal registration as a carer and without any carer's allowance in payment. Second, the spouse and partner exclusion is real, but it does not mean couples in caring situations have no route to a reduction. If the person being cared for qualifies as severely mentally impaired under the conditions described in the previous section, they are disregarded on that basis independently, which leaves the partner as the only counting adult and triggers the single-person discount through a different door. The two disregards interact, and the combination of a carer disregard with a severely mentally impaired disregard in the same household can in some cases remove the bill entirely. An investigation published in January 2026 found that 1 in 5 council websites in England and Wales, including 7 London borough sites, were displaying incorrect qualifying criteria for the carer's disregard. The error traced back to 2013, when the list of qualifying benefits was extended. and a significant portion of councils never updated their public guidance to reflect the change. For more than a decade, carers checking whether they qualified were reading criteria that did not match the law. The investigation estimated that up to 5 million unpaid carers in England and Wales had been potentially deterred from claiming, missing between £500 and £1,000 of support each year. Following the investigation naming 69 councils by name in its findings, all 69 corrected their websites within 4 months. If you are an adult child living in a parent's home or a relative who moved in to provide care, and the person you look after receives attendance allowance or personal independence payment, the question of whether you qualify for the disregard takes approximately 1 phone call to your council to establish. Your income does not affect it. Your savings do not affect it. The hours you are already putting in are the test. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That disregard sits in the same legislation as the single-person discount and the severely mentally impaired disregard, and almost nobody claims it unprompted. But the next reduction on this list works differently again, and it applies specifically to the property rather than the people inside it, cutting the bill for a condition the council already knows about and has never mentioned. Section 5. The disabled band reduction. Something changed about one of the rooms. It might have been a gradual change, equipment arriving in stages, a hospital bed replacing the one that was there before, rails going up beside the bath, and then eventually a wet room replacing the bath entirely. Or it happened quickly, after a stroke or a fall, an occupational therapist visiting and recommending specific changes, and those changes being made within weeks because they were necessary and there was no time for anything to happen slowly. Either way, the room is different now from what it was. The house accommodates something it did not used to accommodate. The council tax bill has not reflected any of that. It arrived with the same band at the top that it has always had, and you paid it, because nothing about the bill suggested that what had happened inside the house had any bearing on the number at the bottom. The disabled band reduction scheme says otherwise. If a property is the main home of at least one disabled person, and that property contains at least one of 3 specific qualifying features, the council tax band is reduced by 1 step. A Band D property is charged at the Band C rate. A Band E property is charged at the Band D rate. Every band drops by 1. If the property is already in Band A, the lowest band, a flat discount of 17% is applied instead, because there is nowhere lower to go. The saving across most of England in 2025 sits between £200 and £500 a year, depending on the local Band D rate. And because council tax rises by between 3 and 5% annually, that gap between what you are paying and what you should be paying widens every year. The claim sits unmade. The 3 qualifying features are specific. An extra bathroom or kitchen that exists because of the disabled person's needs qualifies. A room other than a bathroom, kitchen, or toilet that is used predominantly by the disabled person and is essential or of major importance to their well-being qualifies. And sufficient floor space inside the property to use a wheelchair qualifies, provided the wheelchair is used indoors and not solely outside. On that last point, a wheelchair kept purely for outdoor journeys and never brought inside does not satisfy the condition. One used in the hallway, the living room, between rooms does. The room condition is the one that catches most households by surprise, because the language of the scheme implies structural alteration when what it actually requires is a particular use. A ground floor bedroom set up primarily because mobility has made the upstairs inaccessible qualifies, provided its use is essential to the disabled person's well-being and not simply a convenient rearrangement. A room used for dialysis equipment qualifies. A room used for therapy equipment qualifies. A room used mainly for storage of disability-related equipment can qualify. The room does not need to have been built for the purpose. It needs to be used for the purpose, and that use needs to be essential rather than incidental. 2 things about the scheme sit outside what most households assume. The first is that the disabled person does not have to be the council tax bill payer. An elderly parent living with an adult child who pays the bill, a disabled spouse whose partner manages the finances, a disabled adult child in a property registered to the parents. All of these arrangements qualify, provided the disabled person is resident and the property contains a qualifying feature. The person paying the bill and the person whose condition triggers the reduction can be different people. The second is that most councils will date the reduction from the day the claim is made, not from the day the qualifying feature came into existence. Unlike some of the other reductions on this list, the disabled band reduction does not automatically backdate to when you became eligible. Some councils will consider backdating where there are exceptional circumstances, but the standard position is that the discount runs from the date of application. Every month the claim is not made is a month the full band rate leaves your account without cause. An occupational therapist writing about the scheme described knowing her own family was entitled to the reduction and simply not having the capacity to pursue it, absorbed entirely by the daily reality of caring. That account sits alongside the scheme's own mechanism in an uncomfortable way. The discount exists precisely because disabled people live in adapted properties. The adapted properties are visible to anyone who walks through the door. The bill, which arrives from a council that has never walked through the door, reflects none of it until the claim is made. The room is there, the feature qualifies, the form exists, the reduction runs from the date you ask. That band reduction works on the property itself, and it stacks with every other discount and disregard already covered. But the next item on this list works on a completely different principle, and it applies to any pensioner whose income falls below a threshold the government sets each year and advertises poorly. Section 6. Pension Credit and the Full Wipeout. The letter from the Department for Work and Pensions, when it arrived, told you one thing. It told you what pension credit you were entitled to and when the payments would begin. What the letter did not say, and what no one at the Department for Work and Pensions was required to tell you, was that the council tax bill sitting in a drawer in your kitchen was now something you might not owe at all. Two government systems, both aware of your circumstances, both theoretically designed to support people in your position, and they do not speak to each other. The award letter from one department does not trigger anything at the other. You received pension credit and continued paying council tax because nobody told you that receiving pension credit meant you should stop. Pension credit is the means-tested benefit designed to guarantee a minimum weekly income in retirement. It has two components. The guarantee credit element tops up weekly income to a floor set by government each year, standing at around £227 a week for a single pensioner and £346 a week for a couple in 2025 to 2026. The savings credit element, available to those who reached state pension age before April 2016, provides a smaller top-up for people with modest savings or income above the basic state pension. The guarantee credit is the component that matters most for council tax, because in virtually every local authority area in England, receiving the guarantee credit element entitles a pensioner to 100% council tax reduction, the full bill removed, not reduced by a percentage, not tapered against income, gone. The council tax reduction itself is administered by the local council, not the Department for Work and Pensions. Those are two separate bureaucracies with two separate application processes and no automatic link between them. When the DWP awards pension credit, it does not notify the council. When the council sends the council tax bill, it does not know what the DWP has awarded. You sit between those two systems, and the gap between them is measured in the money that leaves your account each month for a bill you no longer legally owe. Many thousands of pensioners receiving pension credit are paying full or partial council tax for exactly this reason. The mechanism for wiping the bill exists. The two departments have simply never been required to join it up. The number of pensioners who are eligible for pension credit and not receiving it at all is, by the government's own estimates, somewhere between 850,000 and 910,000 households. The DWP publishes these figures annually and describes them as a take-up problem. What they represent in practice is a pool of pensioners paying a council tax bill they are entitled to have removed entirely without knowing the entitlement exists. Research published in 2024 put the total annual value of unclaimed pension credit at £2.5 billion. That figure does not count the council tax that would stop being owed if those claims were made. The application for pension credit takes approximately 20 minutes by phone on a free number and can be backdated by up to 3 months from the date of the claim. A claim made in October can recover the entitlement from July. The council tax reduction that follows requires a separate application to the local council, which most councils allow online, and that application can similarly be backdated 3 months in most areas. The sequence is pension credit first, council tax reduction second, and the second step is the one that most people in this situation never take because they do not know there is a second step. One further point that the standard guidance consistently understates: you do not have to be receiving pension credit to qualify for some level of council tax support. The National Scheme for Pensioners in England provides a minimum guaranteed level of protection that local councils cannot reduce below, and pensioners with low incomes and savings below £16,000 may qualify for a partial reduction even without pension credit in payment. The amount varies by council and by income level, but the threshold for qualifying is higher than most people assume. A pensioner who checked the pension credit eligibility calculator and concluded they did not qualify for the benefit itself may still qualify for a meaningful reduction on the council tax bill. These are separate thresholds, separate applications, and separate outcomes, and conflating them is one of the most expensive assumptions a retired household can make. The bill that has been leaving your account since retirement may have stopped being yours to pay some time ago. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Pension credit wipes the bill for those who qualify, and the application costs nothing but a phone call. But the next item works for a category of pensioner who would never describe themselves as low income, a reduction tied not to earnings, but to something that happened to the property decades before you moved in. Section 7, the care home exemption. The decision happened over weeks, or it happened in a single afternoon in a hospital corridor, when the consultant said something that changed the shape of everything. Either way, by the time it was made, there were other things to think about than a council tax bill. There was a room to sort through, a tenancy or a property to manage, a person to settle somewhere unfamiliar and make feel as settled as possible. And all of that took up the entirety of whatever capacity the family had left after the practical negotiations were done. The direct debit ran on. Nobody thought to cancel it or query it because nobody had the room in their head for the council tax bill at a moment like that. It continued to leave the account each month, paying for a property that was now empty, at a rate set for an occupied household, and it continued for as long as nobody thought to make a single phone call. When a person permanently moves into a residential care home, a nursing home, or a hospital on a long-term basis, the property they leave behind becomes exempt from council tax. Not discounted, not reduced by a band, exempt. No council tax is owed on it, for as long as the care setting remains that person's main residence and the property remains unoccupied. The exemption applies whether the property is furnished or empty, whether it is owned or rented, whether a sale is being organized, or the family has not yet decided what to do with it. The bill that arrived at that address every April is no longer a bill that anyone legally owes. The mechanism is known as the Class E exemption, and the qualifying conditions have two parts. The property must be unoccupied, meaning no one is using it as their main residence, and the person who was liable for the council tax, the owner or the tenant, must have permanently moved to a care home, nursing home, or hospital where they are receiving care, with no intention of returning. That last phrase, no intention of returning, is where families most often hesitate, because in the early weeks of a care placement, the situation can feel uncertain, and the word permanent can feel too final to commit to. What most councils allow, and what the guidance from several authorities confirms, is that if a placement initially treated as temporary is later accepted as permanent, the exemption can be backdated to the date the person first moved into the care setting. The temporary framing at the start does not forfeit the entitlement, it only delays the application. Two connected situations sit alongside this that are worth understanding separately. The first is what happens when one partner in a couple moves into a care home and the other remains in the property. The person in care becomes disregarded for council tax purposes, which means the remaining partner is now the sole qualifying adult in the property, and the single-person discount applies, 25% off the full bill, for as long as that arrangement continues. No additional application is required, beyond informing the council that one adult has moved into residential care. The discount follows automatically from that notification. The second situation is what happens when an adult child or other family member moves into the vacated property to manage a sale or oversee the estate. The exemption ends the moment another person makes the property their main residence. The family member who moves in becomes liable for council tax from the date they occupy it. The property stops being exempt, and the bill recommences, this time in their name. The average Band D council tax bill across England in 2026 to 2027 is just over £2,390 a year. A property left empty following a permanent move into care, sitting through a year of probate or sale negotiations while the direct debit continues to run, is overpaying by the full value of that bill for for every month the exemption goes unclaimed. Families managing a parent's affairs, following an emergency admission, dealing with lasting power of attorney paperwork, care funding assessments, property sales, and all the other administrative weight that arrives alongside a significant health event, are not thinking about the council tax account registered to an empty house on the other side of town. But the council tax account does not pause while those things are dealt with. It runs until someone contacts the council and it stops. The call is straightforward: the name and address of the care home, the date of the permanent move, the council tax account reference number on the original bill. Most councils process the exemption and issue a credit for any overpayment since the move date. The money comes back as a credit against any future liability, or as a refund to the account the direct debit was leaving. The house is empty, the bill is not. That exemption ends the moment another adult moves in, and it applies only to permanent placements. But sitting in the same legislation, almost entirely unclaimed, is a separate reduction that applies to every household sharing a home with someone whose income is low, regardless of what your own income is, and it works by a mechanism that almost nobody who benefits from it knows has a name. Section 8. The second adult rebate. Someone moved in and the single-person discount stopped. That was the calculation as you understood it. You had been living alone, paying 75% of the full bill, and then an adult child came back, or a sibling moved in to share the costs, or a relative needed somewhere to stay, and you had the room. You notified the council because you were supposed to notify the council when circumstances changed, and the council removed the 25% discount because the household no longer contained only one adult, and the bill went back up to the full rate. That seemed to be how it worked. One adult, 3/4 of the bill. Two adults, the whole bill. The logic appeared straightforward, and you accepted it. What the council did not explain, and what most councils do not explain, because doing so would require them to volunteer information that reduces their income, is that a separate mechanism exists for exactly this situation. The second adult rebate is a reduction available only to pensioners, applied not on the basis of your income or your savings, but entirely on the basis of the income of the other adult living with you. If the person sharing your home has a low income, your council tax bill comes down. What you earn, what you have saved, what private pension you receive, none of it enters the calculation. The test runs against them, not against you. The definition of a second adult for these purposes is specific, and it is narrower than it might seem. A second adult is someone over 18 living in your home who is not your partner or civil partner, not a paying lodger or tenant, not a joint owner of the property, and not a joint tenant. They must be living with you on a non-commercial basis, meaning they are not paying you rent. The most common examples are an adult child who has returned home, a parent who has moved in, a sibling sharing the house, or a friend living with you without a formal tenancy arrangement. If the person sharing your home is paying you an agreed rent and could be considered a tenant, they fall outside the definition, and the rebate does not apply. If they are simply living with you as part of the household, and their name is not on the tenancy or the deeds, they are almost certainly a second adult for these purposes. The rebate is calculated on a sliding scale against the second adult's gross income. If they are receiving income support, income-based job seekers allowance, pension credit, or income-related employment and support allowance, the rebate runs to 25% of your council tax bill. If their gross income falls below approximately £195 a week, the rebate is 15%. Between roughly £195 and £253 a week, 7.5%. Above that threshold, no rebate applies. The exact income thresholds vary modestly between councils and are adjusted periodically, but the structure is consistent. A second adult with very low income or no income of their own produces a meaningful reduction in your bill, based on their financial position alone. The situation this most directly addresses is the one that is never framed as a financial entitlement when it happens. An adult child loses a job and moves back into the family home. A grandchild comes to stay while getting back on their feet. A sibling moves in after a difficult period of their own. In each case, the pensioner's single-person discount disappears, and the full bill arrives, and the family absorbs the increase as one of the practical costs of the arrangement. The second adult rebate is the mechanism that can offset that increase, available in the background, requiring only an application form and the second adult's income details to trigger. One procedural detail is worth noting. Many councils conduct what they call a better buy calculation, when you apply for council tax reduction, automatically comparing the value of the reduction you would receive under the standard means-tested scheme against the value of the second adult rebate and awarding whichever produces the larger saving. If you apply for council tax reduction and the council assesses that the second adult rebate would serve you better, it should switch the calculation and apply the higher figure. In practice, not every council does this automatically, and the safer approach is to mention explicitly when applying that you share your home with a second adult on a low income and that you wish to be considered for the second adult rebate alongside any other reduction the council is assessing. The bill went up when they moved in. The bill can come back down. Those are both true at the same time, and only one of them required you to do anything. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. The second adult rebate works on the income of the person living with you and asks nothing about your own. But the next reduction on this list works on a principle that has nothing to do with income or occupancy or disability, and it applies to anyone whose property sits on a street where the council got the valuation wrong in 1991 and has silently corrected it for your neighbors without telling you. Section 9. The Annex Discount. The planning permission came through and the builders arrived, and when they left, there was a new space attached to the side or the rear of the house, with its own entrance and its own kitchen and its own bathroom, and enough room for a person to live in it independently. The reasons for building it were private and practical, and made sense to the people involved. A parent getting older, a child returning from somewhere that did not work out, a relative who needed to be closer without living in the same rooms. The annex solved the problem it was built to solve, and then the council sent a second bill, a separate council tax bill for the new space, with its own band and its own annual charge, and that bill was paid the same way every other bill in the household was paid, because it arrived, and because paying it seemed like the right thing to do, and because nobody suggested otherwise. What nobody suggested, in the majority of cases, is that the bill for the annex should have arrived at half the amount it did. From the 1st of April 2014, a mandatory 50% discount applies to any self-contained annex that is either used as part of the main home or occupied by a relative of the person who is liable for council tax at the main property. The government that introduced the change described the previous arrangement, under which full council tax was charged on both the main house and the annex simultaneously, as an unfair surcharge on family homes. The new rule removed that surcharge and replaced it with a half-rate charge. The discount is not discretionary. Councils are required to apply it. The only thing standing between the bill you have been paying and the bill you should have been paying is the application that nobody told you existed. The definition of a relative for these purposes is broad enough to cover most of the arrangements that typically produce an annex in the first place. Parents, grandparents, children, grandchildren, siblings, uncles, aunts, nephews, and nieces all qualify, along with their spouses or civil partners. If the person living in the annex sits inside that definition and is not paying you a commercial rent, the 50% discount applies to the annex's council tax bill from the date you claim it. The discount stacks with other reductions that may also apply to the annex. If the relative living in the annex is the only adult there, the single-person discount sits on top of the 50% reduction, bringing the annex bill to 37.5% of its full value. If the relative qualifies as severely mentally impaired, under the conditions described earlier in this list, the bill may be removed entirely. That last point opens into a separate category, where the relative living in the annex is age 65 or over, or is substantially and permanently disabled, or qualifies as severely mentally impaired. The annex is not discounted, but fully exempt from council tax under what is known as the Class W exemption. No council tax is owed on it at all. The full exemption and the 50% discount are two distinct outcomes, depending on the relative circumstances, and the difference between them is worth the full value of the annex's annual bill. A relative who is 65 or older, living in a separately banded annex, means the annex bill is zero. A relative who is younger and able-bodied means the annex bill is half of what would otherwise be charged. Both outcomes require the same action, an application to the council with the details of who is living in the annex and their relationship to the main household. When the discount launched in April 2014, the government's own figures showed that around 2,400 homes had claimed it in the first year, saving approximately £1.3 million collectively across the country. The government noted at the time that it believed significantly more households were eligible, and encouraged councils to make residents aware of the discount. That encouragement did not produce any requirement on councils to proactively identify eligible households and notify them. 11 years later, the annex discount remains one of the most consistently unclaimed reductions in the council tax system, sitting unnoticed on properties where a second bill has been arriving at full rate for years. If your property has a separate banded space, converted garage, purpose-built annex, or self-contained flat attached to or within the grounds of your main home, and that space is used by family, the bill for that space is not what it appears to be. Half of it, at minimum, belongs back in your account. That 50% discount applies the moment a relative moves in, and has been available since 2014, whether or not anyone mentioned it at the planning stage. But the next reduction works differently again, and it applies to a situation that every pensioner eventually faces: the moment a property sits empty between one life stage and the next, when the council sends a full bill to an address where nobody is living. Section 10. The probate exemption. The first bills arrived while you were still sorting through the cupboards. There was a folder somewhere with the account numbers in it, or there was not, and either way, the solicitor had a list of things that needed to be notified, and the council tax was on it, alongside the water and the electricity and the phone. The direct debit was still running from the deceased's account, or it had already been stopped, or nobody had got to it yet, because there were other things happening at the same time that felt more urgent and more human and more necessary to deal with first. The bill arrived and somebody paid it, because the bill arrived and somebody always pays it. And that sequence continued for however many months it took for the estate to be settled and the property to be sold or transferred. And the money came out of the estate as one of the costs of closing a life down, and nobody thought to question whether it should. The Class F exemption says it should not have. When a property becomes empty because the person liable for its council tax has died, no council tax is owed on that property from the date of death until probate is granted. That first period has no fixed length. Probate, the legal right to deal with a person's estate, can take weeks or months, or, in complex estates, considerably longer. For the entire period between the death and the moment the grant of probate is sealed, a genuinely empty property owes nothing. After the grant is issued, a further 6 months of full exemption follows, giving executors a window to deal with the property before the bill recommences. The total exemption can run to a year or more in a straightforward estate, and considerably longer in one where probate is delayed. The exemption applies whether the property is furnished or empty, whether it is a house or a flat, whether it is owned outright or subject to a mortgage. The exemption is not automatic. That is the sentence that costs estates money. The council must be notified, and in some areas, the exemption runs from the date the council is told, rather than the date of death, which means a notification made 3 months after a death may lose 3 months of entitlement. The information the council needs is not extensive: the date of death, the property address, confirmation that the property is unoccupied, and a contact address for the executor or the solicitor handling the estate. Most councils accept this online or by email. The death registration process in England includes a service called Tell Us Once, which allows a single notification to reach multiple government departments, including some councils, though coverage is not universal, and a direct notification to the council is advisable regardless. Once the post-probate 6-month window closes and full council tax becomes payable, it is payable by the executor in their official capacity as representative of the estate, not from the executor's personal funds. The estate pays, not the individual. This distinction matters in situations where executors have been paying council tax from their own accounts, assuming personal liability, which occasionally happens when the administration of an estate is handled without professional advice. Any overpayment made from personal funds rather than estate funds can in principle be recovered from the estate once the error is identified. What happens after the exemption period ends, if the property remains empty, is a separate and increasingly significant matter. Councils across England have the power to charge a premium on long-term empty properties, applied on top of the full council tax rate. Properties empty for more than 1 year after the exemption period expires can attract a premium of 50%, meaning the bill runs at 150% of the standard charge. Properties empty for more than 5 years attract 100% premium. Properties empty for more than 10 years attract 200%. The trajectory from exemption to premium is steep, And the timeline moves quickly once the 6-month post-probate window is gone. An estate managing a property that is taking time to sell has a shrinking window before the council tax liability begins to compound. The practical implication for any pensioner managing a parent's estate or any executor dealing with a property left behind after a death is that the first call to the council should happen immediately, before any other administrative steps are taken, before the solicitor has produced a full schedule, before probate has been applied for. The exemption begins when the council is told. Every week of delay at the start is a week of entitlement that does not come back. The bill arriving at an empty address is not a bill that is owed. It is an invoice sent to an account that the law has suspended, and the law suspended it the day the key turned in the lock for the last time. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That exemption runs from the date of death and buys the estate months of breathing room before the bill returns. But the next reduction on this list applies not to empty properties or bereaved households, but to anyone paying council tax on a property that was never correctly measured when the whole system was built, and the error has been hiding in plain sight on the council's own valuation list ever since. Section 11, the Property Attribute File. Somewhere in a government database, there is a description of your home, not a rough categorization, and not just a band letter, but a detailed record specifying what type of property it is, when it was built, how many rooms it contains, how many bedrooms and bathrooms, how many floors, and what the floor area is measured in square meters. That record was created in or around 1991, when the Valuation Office Agency was working through the country's housing stock at speed, and in many cases, the person who created it never came inside. They looked at the front of the building, made a judgment about the back, consulted whatever planning records were available, and logged what they concluded. That log description has been sitting in the system ever since, forming part of the basis on which your band was calculated, and you have never been shown it and have never been asked to confirm whether it is accurate. The record is called Property Attribute Data, or PAD, and it is your legal right to request a copy of it for free. The Valuation Office Agency holds this data on every residential property in England and Wales, and any council taxpayer can ask to see the entry for their own home. The request goes to the Valuation Office directly, either online through the VOA's website, by email to their customer service address, or by phone, and the data comes back showing exactly what the government believes your property to be. The information it contains is the raw material the VOA used to place your home in its band. If that information is wrong, the band may be wrong for a reason you could not have identified by looking at the band alone. The VOA's own published analysis of its property checking processes found that around half of all incorrect information identified during property reviews relates to the number of rooms and their sizes. Almost a fifth of the inaccuracies relate to heating and air conditioning. Properties recorded as having more rooms than they actually contain are common. Properties recorded as a different type to what they are. A house logged as a flat, a maisonette, recorded as a terraced house, occur with enough frequency that the VOA's internal quality assurance process flags specifically for logical impossibilities in the data, catching entries like bungalows, described as having multiple floors. Those are the errors obvious enough to be caught automatically. The less obvious ones, a floor area recorded at the wrong measurement, a room count that includes a space converted after 1991, or miscounts a room that does not exist, sit in the record unquestioned until someone requests the file and reads it against the reality of the building. The reason checking the property attribute data matters before making a band challenge is that it can reveal an error more direct and more provable than a comparison of neighboring bands. A neighbor's band being lower than yours is evidence that supports a challenge, but it requires the Valuation Office to accept a relative argument about 1991 values. A property attribute data file, recording your home as containing 6 bedrooms when it contains 4, is a factual error that does not require any argument about relative value at all. It requires only the correction of a fact that is demonstrably wrong, and that correction then propagates into the band calculation. A significant error in the data, one affecting floor area or room count in a meaningful way, can lead directly to rebanding without the need to build a case from comparable properties at all. The process for checking the data is free and straightforward. Request the PAD from the Valuation Office Agency. Read it against the actual configuration of your home, and identify any discrepancy between what the record says and what the building contains. A difference of one bedroom in either direction in a small terrace is unlikely to move the band. A floor area recorded at significantly more than the measured reality, or a property type that does not match the actual building, carries more weight. If you find an error, you report it to the VOA as a factual correction, not as a challenge in the formal sense, and the VOA reviews the record and amends it if the evidence supports the change. The data request takes a few minutes to submit. The response comes back within a standard processing period. The comparison between what the record says and what you can observe by walking around your own home takes however long it takes to count rooms and look at the printed floor area figure. The Valuation Office has held this description of your property since 1991. They wrote it from the outside. You are the person who has lived in it since, and the one most likely to notice when the description does not match the building. That file has been sitting in the government's records since before most of the properties on your street changed hands, and it may describe a house that does not match the one you live in. But the next reduction on this list requires no file request and no challenge process at all, and it applies to any pensioner who picks up the phone to the council and asks a single question nobody thinks to ask. Section 12. The discretionary reduction. There is a power sitting in local government legislation that every council in England is legally required to operate, and almost none of them advertise. It was written into Section 13A of the Local Government Finance Act 1992 and expanded by the Local Government Finance Act 2012. And what it says, in plain terms, is that any billing authority can reduce any council tax bill for any person to any amount it thinks fit, including reducing it to zero, not for a specific category of household, not for a specific type of property, for any person, in circumstances the council decides warrant it, by whatever amount the council decides is appropriate. The discretion is absolute. The power to grant the reduction exists, and every council taxpayer in England has the legal right to make an application for it. The question nobody asks is whether they can apply. The answer is always yes. Every council must have a published policy explaining how it operates its Section 13A scheme. The policy sets out what factors the council takes into account when assessing an application. Most policies list some version of the same considerations: whether the applicant has exhausted all other available discounts and exemptions, whether there is evidence of genuine financial hardship or unforeseen exceptional circumstances, whether the applicant has access to other funds or assets that could be used to meet the liability, whether the difficulty is the result of something outside the applicant's control rather than a deliberate refusal to pay. The council weighs those factors and decides. Its decision must be communicated in writing within 14 days, and if the decision is to refuse, the applicant has the right to appeal to the Independent Valuation Tribunal. The reason this power is not well known is straightforward. Unlike every other reduction on this list, the Section 13A discretionary reduction is funded entirely by the council from its own budget. A central government grant does not reimburse the council when it exercises this power. The money comes directly out of the council's own resources. That financial structure provides no incentive for the council to publicize the scheme aggressively, and it produces the outcome you would expect from a power that costs the body operating it, which is that the scheme exists, functions correctly when applications arrive, and receives approximately no proactive communication to the people who might benefit from it. The circumstances that most commonly produce a successful application are the circumstances that most commonly arrive without warning in later life. A sudden and significant health event that generates costs the household cannot absorb. A major structural repair to a property that consumes the available savings and leaves nothing to meet the tax bill. The death of a partner whose pension income has not yet been replaced by the surviving partner's own entitlement, leaving a temporary gap that the monthly bill falls into. A care funding assessment that arrives and takes a larger portion of income than anticipated. These are not unusual situations for a pensioner household. They are the situations that retirement planning is supposed to prepare for, and that no amount of planning fully anticipates. The application for a Section 13A discretionary reduction is made in writing to the council tax team at the local authority. Debt advice organizations and legal advice charities published template letters for this purpose. The letter sets out the applicant's circumstances, describes the nature of the hardship, confirms that other relevant discounts and exemptions have been considered, and asks the council to exercise its discretion under the relevant legislation. The council receives the letter, assesses it against its published policy, and responds within the statutory 14-day window. The outcome is not guaranteed. The discretion is genuine. But the outcome of not applying is also not guaranteed, and the only guaranteed outcome of not applying is that the bill continues at its current level, regardless of the circumstances behind it. One procedural point that experienced debt advisors emphasize: the application must confirm that other eligible reductions have been explored before the Section 13A route is pursued. A council that receives an application from a pensioner who has not yet applied for the single-person discount or has not checked their eligibility for council tax reduction will almost certainly decline the discretionary application and direct the applicant to those routes first. The Section 13A power is positioned as a last resort after the standard system has been fully applied. That sequencing is not a barrier. It is simply a reason to work through the list in order. Apply for everything the standard system offers, and then, if the bill that remains is still beyond what the household can manage, write the letter. The council has the power. The law has always given it the power. The application takes one letter. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That discretionary power sits in every council's policy document, and almost nobody applies for it. But the next item on this list requires no application at all, no means test, and no evidence of hardship, and it applies to anyone who has been paying their bill in 10 monthly installments when the law allows them to pay it in 12. Section 13, the 12-month spread. Every April, the same thing happened. The bill arrived, and the direct debit was reset, and the first payment went out on the 1st of the month. And that continued through April, May, June, July, August, September, October, November, December, and January. 10 payments. The last one leaving in the first week of the year. And then nothing in February and nothing in March, and the sense, briefly, that the bill had been dealt with. Then April again. The 10-month cycle restarted. And if you were managing a fixed income that arrived on a particular day each month, the relationship between when the pension landed and when the council tax left was something you had absorbed as a fixed condition of the monthly budget, not as something you had ever chosen or could change. The default council tax payment schedule in England runs from April to January. 10 installments, approximately equal in size, spread across those 10 months. February and March contain no payment under the standard arrangement. The 2 quiet months are not discounts. The annual bill is the same. The money paid between April and January covers the full year, including February and March, which means the 10-month plan compresses 12 months of liability into 10 months of payments, making each monthly amount higher than it would be if the same total were divided by 12. The council sends the 10 installment bill because 10 installments is the default, and the default runs until someone asks for something different. The legal right to pay over 12 months instead of 10 is available in England to any council taxpayer who requests it. The request is a single contact with the council, made by phone, by email, or through an online form that most councils have provided for exactly this purpose. The council recalculates the bill across 12 months instead of 10, sends an amended payment schedule, and the arrangement runs indefinitely from that point. No means test applies. No reason is required. The right exists regardless of whether the household is in financial difficulty or not, and most councils process the change within a standard 10 working day window. What the 12-month spread produces in practice is a reduction in each monthly payment of approximately 17% against the 10-month equivalent. A household paying £2,000 a year in 10 installments of £200 each month pays instead in 12 installments of approximately £166. The total is identical. The monthly amount is lower by £34. For a pensioner managing a fixed income with limited flexibility, a reduction of £34 in a single regular outgoing is not a rounding error. It is a utility bill. It is 2 weeks of a basic food shop. It is the margin between a month that closes in balance and one that does not. The payment date is a related option that most councils extend without advertising. The standard payment date is the 1st of each month, but most councils allow the payment date to be shifted to the 15th or the 25th, and some offer additional dates depending on the direct debit options available. The state pension is paid weekly or every 4 weeks, not on the 1st of the calendar month. Private pension income arrives on varying dates depending on the pension provider. A council tax direct debit, landing on the 1st of April before the pension income has cleared, is a structural timing problem with a structural solution. Ask the council to shift the payment date to a point after the income lands. The council adjusts the direct debit. The timing problem stops. Neither of these options appears on the annual council tax bill. The bill states the amount due and the 10 installment payment schedule and the direct debit date, and it does so without a note explaining that the schedule is adjustable on request. A pensioner reading the bill sees a set of dates and amounts that appear to have been decided for them, which is accurate only in the sense that the defaults are decisions made by an administrator who had no information about when that particular household receives its income. The defaults serve the council's preference for predictable collection. They were not chosen with the timing of a state pension payment in mind. The change takes one contact with the council. The 12-month arrangement, once established, remains in place for subsequent years automatically. The payment date, once changed, stays changed. Both adjustments make the largest regular outgoing in many pensioner households arrive in a shape that fits the income that pays for it, without reducing the total owed by a single pound or requiring any evidence that the change is needed. The bill was never fixed, it was just never challenged. That adjustment requires nothing more than a phone call and applies to any council taxpayer regardless of circumstances. But the next item on this list is something altogether different, a reduction most pensioners have never heard of that applies specifically to households where someone has recently been hospitalized, and the window to claim it is shorter than almost anyone realizes. Section 14. The terminal illness exemption. The diagnosis arrived in a room that was not your living room, and not your kitchen, and not any room in the house where the council tax bill lived in its drawer. It arrived in a ward, or a consulting room, or a corridor conversation after a scan, and by the time the family drove home, the list of things that now needed to be dealt with had grown into something that occupied every available hour and left nothing over for the kind of administrative task that a council tax exemption requires. The bill continued to arrive every month. The direct debit continued to run. The family paid it from the same account it had always come from, because the bill kept coming, and the bill had always been paid, and because nobody in that house, in those weeks, had the capacity to think about whether the bill was still something they legally owed. In June 2025, Manchester City Council became the first local authority in England to introduce a full council tax exemption for households where a resident had been diagnosed with a terminal illness. The exemption removed the entire bill for the duration of the illness and continued for 2 months after death to give surviving family members a period of stability before the charge resumed. The policy was developed in partnership with Marie Curie, the end-of-life charity, whose research had documented that more than 300 people die in poverty in the United Kingdom every single day, and whose campaign had spent several years pressing local authorities to reduce the financial burden on households approaching the end of life. Within months of Manchester's announcement, other councils had followed. Bristol introduced its scheme from November 2025, Barnsley from October 2025, Sefton from January 2026, Wakefield from April 2026, Cheshire West and Chester from April 2026. Burnley committed to the policy. The list continues to grow. The mechanism in every case is the Section 13A discretionary power, covered earlier in this list, applied to a specific class of case rather than on a purely individual basis. Each council that has adopted the policy has set out its own qualifying criteria, but the common standard across all of them is the SR1 form. An SR1 is a medical evidence form completed by a clinician, a doctor, a nurse consultant, or a specialist, confirming that a patient is believed to be approaching the end of life within 12 months. The form already exists in the NHS system and is used across several benefit and support schemes. For the purpose of the council tax exemption, the household submits a copy of the SR1 to the council, and the exemption is applied from the date the form was issued. No income test, no means test, no assessment of what the household earns or owns. The SR1 is the evidence, and the evidence is sufficient. The window this creates is one of the genuinely short ones in this entire list. The exemption applies while the person is alive and for a defined period after death. An application made the day after the SR1 is issued receives the full benefit from that date. An application made 6 weeks later receives the benefit from the SR1 date in most councils, but loses nothing because the scheme is still running. An application that is never made because the family did not know the exemption existed generates no benefit at all. There is no retrospective claim after death. The window opens with the SR1 and closes with the person who held it, and the only households that benefit are the ones where someone made the connection between the diagnosis and the bill before the opportunity passed. The postcode element is significant and honest and cannot be resolved here. Whether your council has adopted this policy depends entirely on where you live. The movement is growing, driven by Marie Curie's national campaign, and an increasing number of councils are introducing schemes modelled on Manchester's original policy. Some councils that have not formally adopted a scheme may still consider individual applications under the existing Section 13A discretionary power for terminal illness cases. The first step, regardless of whether a published policy exists in your area, is to contact the council tax team, explain that someone in the household holds an SR1, and ask whether any reduction is available. The worst outcome is that the council says no and directs you to existing means-tested routes. The best outcome is that the bill stops. No household navigating a terminal diagnosis should also be navigating a council tax bill that it is not required to pay. The SR1 is already in the folder. The council needs to be told it exists. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That exemption requires a single document and a single contact, and it ends the bill for the period that matters most. But the next item on this list involves no diagnosis and no document, and it applies to any pensioner who moved into their current home more than 30 years ago and has never once been asked whether the number on their bill matches the property they actually live in. Section 15. The Attendance Allowance Gateway. Nobody sat down with you and asked whether you needed help getting out of the bath. That is not the kind of conversation that happens at a council tax office, or in a letter from the local authority, or in anything that arrives bearing the council's logo. The question of whether you struggle with washing, or dressing, or preparing a meal, or moving around your own home is a medical question and a personal question, and the connection between how you answer it and the council tax bill in the kitchen drawer is a connection that nobody in the system is required to draw for you. So the bill arrived and you paid it, year after year, while a benefit worth several £1,000s annually sat unclaimed in a system that knew where you lived and had your council tax account number, and never once used either piece of information to ask the question. Attendance allowance is a tax-free, non-means-tested benefit for people over state pension age who need help or supervision because of physical or mental illness or disability. Income does not affect eligibility. Savings do not affect eligibility. You can own your home, have a private pension, and hold savings above any threshold the means-tested system would normally apply, and still be entitled to attendance allowance in full if your physical or mental condition requires regular help or supervision during the day, during the night, or both. It pays at a lower rate for those who need help during the day or night alone, and at a higher rate for those who need help during both day and night, or who are terminally ill. The rates for 2026 to 2027 sit above £70 a week at the lower rate and above £100 a week at the higher rate. Research published by the social policy organisation Policy in Practice estimates that around 1.1 million pension-age households in the United Kingdom are eligible for attendance allowance and not claiming it, with approximately £5.2 billion going unclaimed every year. That figure makes attendance allowance the single largest unclaimed pensioner benefit in the country by total cash value. The reasons the benefit goes unclaimed follow a pattern that runs through every other item on this list: a lack of awareness that it exists, an assumption that savings or income would disqualify the claimant, a reluctance to describe daily difficulties in writing, a form that runs to around 40 pages and requires specific language to describe functional impairment in ways that match the assessment criteria. The charities Age UK, Citizens Advice, and Independent Age will help anyone complete the form for free, and their assistance significantly improves the quality of the application. The connection between attendance allowance and the council tax bill is the point that this section exists to make, and it is more direct than it first appears. Attendance allowance is a qualifying benefit for several of the reductions already covered in this list. It is one of the benefits that the person being cared for must receive for the carer's disregard described in Section 4 to apply. It is one of the qualifying benefits for the severely mentally impaired disregard in Section 3, and at the higher rate, receiving attendance allowance can trigger a top-up within the pension credit system. that brings income below the guarantee credit threshold for some households that previously sat just above it, which then unlocks the 100% council tax reduction described in Section 6. That last chain is the one that produces the most significant outcome, and that works as follows. A pensioner receives a state pension and a small private pension that together place their income modestly above the pension credit threshold. They do not qualify for pension credit, and therefore do not qualify for the council tax reduction tied to it. They develop a condition over several years that now requires daily help. They claim attendance allowance at the higher rate. The pension credit system contains a component called the additional amount for severe disability, payable to people who receive the higher rate of attendance allowance and live alone, or whose carer does not receive carer's allowance. Adding this component to the income assessment brings the pensioner within the guarantee credit threshold. They now qualify for pension credit. Pension credit triggers the 100% council tax reduction. The bill goes to zero. That sequence does not happen automatically. Each step requires an application, and the next step requires a separate application. But the sequence is real, it is legal, and it is available to any pensioner who has been living with a condition that affects their daily life without ever framing that difficulty as something with a financial consequence attached to it. 5 London Borough Councils ran a targeted outreach program that wrote to residents potentially eligible for attendance allowance. The program identified more than 500 new claims in a single year across those boroughs, unlocking more than £1 million annually in attendance allowance payments, plus the cascade of additional entitlements those payments triggered. The question was never asked. The answer was always there. That gateway runs from a condition already present in the house, to a benefit unclaimed for years, to a council tax bill that may not need to be paid at all. But the next reduction on this list requires no condition and no benefit and no application to any government department, and it applies to any pensioner who has sat with a neighbour over tea and never thought to compare the number at the top of the respective bills. Section 16. The neighbour comparison. Your street is a public document. Every property on it, the semi at number 4 and the semi at number 12, and every house running in both directions from your front door, has a council tax band registered on a government database that anyone in the country can access for free, without an account, and without a password, and without any relationship to the property in question. The bands are public because the council tax valuation list is public, and it has always been public, and the tool that displays it has been available online since well before most households had a fast broadband connection. You have lived on your street for decades, paid your council tax every April without questioning the band at the top of the bill, and the information that would tell you whether your band is correct or incorrect has been sitting one postcode search away the entire time. The Valuation Office Agency maintains the official register of council tax bands for every property in England and Wales. The website address is gov.uk/council-bands. You type your postcode. The page returns a list of every property in that postcode with its band beside the address. You scroll down the list and read the bands against the addresses, and you look, in particular, at the properties most similar to yours. The properties built in the same decade, on the same side of the road, or the same estate, with the same number of bedrooms and the same general configuration. In Scotland, the Scottish Assessors Association at saa.gov.uk operates the equivalent register. The search works the same way. No fee applies. No sign-in is required. What you are looking for is a discrepancy, and the discrepancy you are looking for is specific. Similar properties on the same street in a lower band than yours. A row of identically built terraced houses from the 1950s, where 7 are in Band C, and yours is in Band D. A small estate of matching semi-detached properties, where the houses on the left of the main road are in Band C, and the houses on the right, which include yours, are in Band D. These discrepancies are the evidence the Valuation Office Agency accepts when you submit a band challenge, because similar properties on the same street should have had similar market values in April 1991, and if they were assigned different bands, the most likely explanation is that one of them was assessed incorrectly. The Valuation Office accepts up to 5 comparable properties in lower bands as evidence for an informal review. The comparables must be similar to yours in type, age, style, and size. A terraced house compared against a detached house at the end of the road does not constitute a valid comparable. A 3-bedroom semi compared against other 3-bedroom semis from the same building period does. The closer the similarity, the stronger the evidence, and the strongest possible evidence is an identical pair of properties side by side, or a short run of properties from the same development where yours is the only one sitting in the higher band. The Valuation Office Agency published its own statistics on challenge outcomes, which show that in 2023 to 2024, around 27% of resolved challenges resulted in a band reduction. 1 in 4 who challenged with adequate evidence succeeded. The challenge costs nothing to submit. It is made online through the government's own portal, or by phone to the VOA's customer service line, or in writing. The VOA reviews the evidence, assesses the comparable properties, and responds with a decision. If the challenge succeeds, the band is reduced and the correction is backdated. If it fails, the band stays as it is, and you have lost nothing but the time it took to make the call. The risk that warrants understanding before proceeding is the same one covered in the opening section of this list. The Valuation Office, when reviewing one property following a challenge, may also look at the comparable properties submitted as evidence. If those properties are in a lower band than their size and type in 1991 would have warranted, the review can result in their bands being moved upward rather than your band being moved down. The neighbors whose properties you cited as evidence can find their bills increasing rather than yours decreasing. This outcome is uncommon, but it is real, and it is the reason every piece of guidance on this process says the same thing. Run the comparison carefully, identify properties that are genuinely similar to yours, and submit only comparables where the disparity works clearly in your favor before proceeding to a formal challenge. The register is public, the tool is free, the postcode is already in your head. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That comparison takes 2 minutes and a postcode, and can open a challenge worth hundreds of pounds a year. But the next reduction on this list requires no comparison, and no challenge, and no form at all, and it applies to any pensioner who has been paying their bill in full while an adult student has been sleeping in the spare bedroom and counting as a second adult when the law says they should count as nobody. Section 17. The student disregard. The grandchild arrived in September with boxes and a university offer letter, and the particular energy of someone starting something new, and the room that had been a spare room became a bedroom again, and the house became noisier than it had been, and that was a good thing, mostly. And the council tax bill went up, because naturally it went up, because there were now 2 adults in the property, and the single-person discount disappeared the moment a second adult arrived. And that sequence seemed correct and logical, and you accepted it without question, because that was how it had always worked, and how it appeared to continue to work, month after month, until the grandchild graduated and moved out, and the discount reappeared, and the bill came back down. For 2 or 3 or 4 years, while the grandchild was studying, you paid the full rate. You paid it because a second adult was in the house. What you did not know, and what nobody told you, was that a full-time student does not count as a second adult at all. Full-time students are disregarded for council tax purposes. That is the specific legal term and the specific legal effect. They are not counted when the council works out how many qualifying adults live in a property. A household containing 1 pensioner and 1 full-time student at university contains, for council tax purposes, 1 qualifying adult, and a single qualifying adult household receives the 25% single-person discount. The bill should have been running at 75% of the full rate for the entire period the grandchild was enrolled. The difference between what was paid and what should have been paid represents up to 4 years of a 25% overpayment, and the council can be asked to refund it. The qualifying conditions for full-time student status are set nationally and apply everywhere in England, Scotland, and Wales. A course qualifies if it lasts for at least 1 full academic or calendar year, requires attendance for periods totaling at least 24 weeks in the year, and involves at least 21 hours of study, tuition, or work experience per week during term time. Degrees at universities qualify. Full-time further education courses at colleges qualify. The relevant institution is legally required to issue a council tax exemption certificate confirming the student's status, and they must do so unless more than a year has passed since the course ended. The pensioner takes that certificate to the council, and the disregard is applied. The process requires 1 certificate and 1 notification and costs nothing. The scenario that catches most households is the reverse of what feels obvious. When a student arrives, the instinct is to notify the council that a second adult has moved in, because that is what the guidance says to do when circumstances change. The council removes the single-person discount and the bill goes up. What the council does not then say, because nothing in the notification process prompts it, is whether the new arrival qualifies as a disregarded person. The council receives a notification of a change, applies the standard outcome of removing the discount, and the household pays the higher rate indefinitely, while the relevant certificate sits unsubmitted in someone's email inbox from the university admissions department. The disregard applies to student nurses as well as degree students. It applies to apprentices who are disregarded under a separate but adjacent provision, and it applies, in a more time-limited way, to school and college leavers between the ages of 18 and 19. Any 18 or 19-year-old who leaves school or college after the 30th of April in any given year is automatically disregarded from that date until the 1st of November of the same year, covering the summer period before they begin work or a course. If a grandchild or other young person in that category has been living in the household during those summer months, the disregard should have been in place and the single-person discount should have been running. It was not a discount that had to be applied for. It was a status that existed by law from the moment the school term ended. Part-time students do not qualify. The 21 hours a week threshold exists to separate full-time study from part-time, and a student on a part-time course counts as a qualifying adult for council tax, regardless of what fraction of a full-time load they are carrying. The disregard attaches to the full-time status, not to the student label. The university or college can date the exemption certificate to the start of the course. That date becomes the date from which the disregard and the corresponding discount should have applied. The refund for overpayment between that start date and the date the disregard was eventually applied is the council's obligation once the certificate is submitted. Nobody has to argue about it. The certificate provides the date. The calculation follows from the date. The grandchild graduated and moved out, and the discount came back, and the whole episode concluded as if it had worked correctly. It had not worked correctly from the 1st September. That disregard runs from the first day of enrollment and applies whether the student is your grandchild, your lodger, or anyone else in full-time education under your roof. But the next reduction on this list works on an entirely different principle, and it applies to any household where the council has been sending 2 bills to an address that should only ever have received 1. Section 18. The holiday let reclassification. The cottage had been in the family for years, or it was bought in retirement as a place to go in summer and rent out when you were not there, or it was inherited and kept because selling it felt wrong, and it covered its costs, and it had always just about worked financially. The council tax bill arrived every April, the same as the bill at your main home, and you paid it the same way, as one of the costs of having the property, a fixed outgoing that simply existed alongside the insurance and the maintenance and the letting agent fees. Then from April 2025, the second home premium arrived in many council areas, a provision introduced under legislation that allowed local authorities to charge an additional 100% on top of the standard rate for properties used as second homes, meaning the bill doubled overnight without any change to the property itself. The total annual charge became 200% of the standard council tax rate, payable every year the property sat in the residential system, and most owners of holiday properties absorbed that increase as a new fact of ownership because nothing in the bill explained that a different classification existed. A property used as a holiday let in England can be moved from the council tax system into the business rates system, and the consequences of that move for a small rural or coastal property used for genuine short-term lettings are substantial. The threshold for the reclassification requires the property to be available for short-term commercial letting for at least 140 days in a 12-month period, and to have been actually let to paying guests for at least 70 of those days. The days that count are paid commercial bookings of short stays. Free use by family does not count. Long-term tenancies generally do not count. The 70-day actual letting threshold and the 140-day availability threshold both have to be met in the same 12-month period for the property to move from council tax liability to business rates liability. Once the property is in the business rates system, the amount payable is calculated against its rateable value, a figure set by the valuation office agency based on the property's size, location, type, and earning potential. A small holiday cottage with a rateable value at or below £12,000 pays no business rates at all, because small business rate relief removes the entire liability for any business property with a rateable value at or below that threshold, provided it is the owner's only business property. A property with a rateable value between £12,000 and £15,000 attracts tapering relief, with the bill reducing from the full amount towards zero across that range. Most small, rural and coastal holiday properties, the kind a retired couple might own and occasionally let out, carry rateable values within the relief thresholds. The result of reclassification for those properties is a bill that moves from 200% of the local council tax rate to nothing. The furnished holiday let tax regime, which provided separate income tax benefits to short-term letting landlords, was abolished in April 2025. That abolition removed those specific income tax reliefs, but left the business rates rules for holiday lets entirely unchanged. A property that meets the 140 and 70-day thresholds still qualifies for business rates classification. The two systems, the income tax regime and the business rates classification, were always separate, and the end of one did not affect the other. The practical requirements for maintaining the classification are the same as the requirements for achieving it. Accurate records of booking dates and availability periods must be kept, because the Valuation Office Agency can ask for evidence. A year in which the 70-day actual letting threshold is not met can result in the property reverting to council tax, potentially with the second home premium reinstated from the point of reclassification. Owners who let sporadically, who use the property themselves for several months and let it for the remainder, need to assess their letting pattern honestly against the thresholds before applying. The reclassification is not automatic. It requires a formal notification to the Valuation Office Agency, demonstrating that the qualifying thresholds are met. The VOA then assesses the property for business rates rather than council tax. The local council is notified. The council tax billing ceases and the business rates assessment begins, followed by the small business rate relief application to the local authority. A pensioner paying a doubled council tax bill on a property that is genuinely used as a commercial holiday let is paying the wrong bill. The correct bill for a property meeting the thresholds and qualifying for small business rate relief is nothing. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That reclassification eliminates the bill for the right property and costs nothing to apply for. But the next item on this list applies not to holiday cottages, but to the property where you have lived for decades. And it concerns something that happened to the value of your home in 1991 that the council recorded incorrectly and has carried forward on the bill ever since, without once checking whether the figure it used was right. Section 19, the 1991 valuation check, somewhere in a box or a filing cabinet or a folder that has moved with you through every house you have ever lived in. There may be a document from a decade before council tax existed that is now worth examining. A mortgage offer letter, a completion statement from a solicitor, a valuation certificate from a building society, an estate agent's particulars with a price printed across the top. If you bought your home in the years running up to 1991, or in the years immediately after, that document contains the closest thing available to direct evidence of what your property was worth at the moment the entire council tax system was calibrated. And if the figure in that document falls in a different band from the one you have been paying against for 30 years, you have the beginning of a challenge that does not depend on any neighbor's band and does not require any comparison with the house across the road. The council tax system in England assigns every property to one of 8 bands based on an estimated open market value as of the 1st of April 1991. The bands are fixed. Band A covers properties valued up to £40,000. Band B from £40,001 to £52,000. Band C from £52,001 to £68,000. Band D from £68,001 to £88,000. And the remaining bands run upward through higher values from there. The valuation that placed your home into its band was made by the Valuation Office Agency in 1991, using whatever information was available to them at the time, which in many cases was very little. The figure they used was an estimate, and the estimate was never published. You were not told what your home was judged to be worth. You were told its band letter, and the band letter has sat at the top of your bill ever since. The Nationwide Building Society publishes a historical house price calculator that uses its own mortgage lending data going back to the early 1970s. You enter a property's sale price and the date of the sale, set the comparison date to the second quarter of 1991, and the calculator produces an estimated value for the property at the April 1991 valuation date. The result is not precise. It uses regional average price movements rather than street-level data and it will not produce the exact figure the valuation office used. But it can tell you, quickly and for free, whether your home's estimated 1991 value sits comfortably in the middle of its band, near the middle, or near one of its edges. Near the edge is where it matters. A property currently in Band D, with an estimated 1991 value of £70,000, sits in the middle of the band and is unlikely to have been misbanded. A property in Band D, with an estimated 1991 value of £69,000, is within £1,000 of the boundary between Band C and Band D, and given the acknowledged imprecision of the 1991 valuation exercise, a boundary that close to the estimate is worth investigating further. The nationwide calculator cannot be used as formal evidence in a challenge, and the valuation office will not accept it as such. What it can do is tell you whether it is worth looking for something that can. What the valuation office will accept is actual sale price evidence from around the valuation date. A property that sold between 1989 and 1993 at a price that places it in a lower band than the one assigned is the strongest possible evidence a challenge can be built on, because it is not an estimate and not a comparison with another address. It is a documented transaction for that specific property at a specific moment close to the point the system was calibrated. Pensioners who have owned their homes since before 1991 and who have the purchase paperwork still available are holding exactly this kind of evidence. A completion statement showing a purchase price of £63,000 in 1988, adjusted through the nationwide calculator to an estimated April 1991 value of around £62,000, places the property firmly within Band C. If the property is currently in Band D, the completion statement and a supporting calculation form the core of a challenge. Land registry data for England and Wales is publicly available from 1995 onward, covering every sale from January of that year. Properties in your street that sold in 1995 or 1996 carry prices from which an estimated 1991 value can be back-calculated, and those back-calculated figures can help support or undermine the case for your own band. The land registry search is free at gov.uk. The historical price data is public, and the calculation from a 1995 sale back to a 1991 estimate is the same nationwide calculator used in reverse. The figure the valuation office used in 1991 was their best guess at a property they may never have entered. The documents in your filing cabinet record what the property was actually sold for. Those two numbers may not match. That valuation evidence is sitting in a folder that has not been opened in years, and the challenge it could support is free to make. But the last item on this list before the final section requires no folder and no document and no calculation, and it applies to any pensioner who has simply never thought to ask a single question that the council is legally required to answer within a fixed number of days. Section 20. The data request. The council has a file on your council tax account. Not just the band letter and the annual total, but a complete record of everything that has ever happened on that account since the day it was opened. Every phone call logged, every note added by a member of staff after any interaction, every assessment made when your circumstances were last reviewed, every discount application received, and every decision made about it. Every piece of information the council holds about who lives at your address and what it believes about your household. That file exists. It is held under your name and your property address, and under Article 15 of the UK General Data Protection Regulation, as enshrined in the Data Protection Act 2018, you have the legal right to request a copy of all of it. The council is required to respond within 1 calendar month. The request costs nothing. The single question is, what personal data do you hold about me? A subject access request to a council tax authority is not the same as challenging a band or applying for a discount. It does not require any evidence and does not make any claim about what the bill should or should not be. It is a request for information made under data protection law rather than council tax legislation, and it sits in a completely different part of the council's administrative process from the revenue and benefits team that manages your bill. You are entitled to the data. The council must provide it. Those two facts exist independently of whatever else is or is not happening with your account. What a council tax subject access request can reveal is not always comfortable reading. Councils hold internal notes made during telephone conversations that the caller never saw. They hold records of assessments and eligibility checks that were run on the account and never communicated to the bill payer. They hold documentation of decisions made about discounts and reductions including decisions not to apply a reduction and the reasoning recorded for that decision. In some cases, those records will show that a staff member noted a household characteristic that might have qualified for a reduction, did not escalate it, and the opportunity was never followed through. In other cases, they will show that incorrect information about the property or the household has been sitting in the system for years, informing the bill calculation without anyone ever checking whether it remained accurate. The right to rectification accompanies the right of access. If the subject access request returns data about you or your property that is factually incorrect, you have the legal right to write to the council requesting that the inaccurate data be corrected. The council must tell you what it has done in response to that request within 1 calendar month. An address recorded incorrectly, a household composition logged as having 2 adults when one has long since left, a note in the system that the property has a feature it does not have, a flag indicating a decision was made on a basis that was never verified. All of these can be identified through the SAR, and all of them can be challenged through the rectification right. The practical value of the SAR in a council tax context lies most directly in situations where previous applications or queries produced unexpected outcomes. A discount that was applied for and denied, a review that was supposedly carried out but produced no change to the bill, a call made years ago that was resolved in a way that never seemed fully satisfactory. The SAR pulls everything the council holds and puts it in front of you in one document, and the gaps between what was said at the time and what the records actually show are sometimes substantial. The request is made in writing to the council, addressed specifically to the data protection officer or the data protection team, rather than the council tax department. Most councils have an online form for this purpose. The request should specify that it relates to council tax records and include the account reference number from the bill, which ensures the correct team can locate and compile the relevant data efficiently. Identification will be required, usually a copy of photo ID and proof of address. The process then runs on the data protection timeline, not the council tax timeline, and the two are governed by entirely different legislation with entirely different oversight. The Information Commissioner's Office monitors compliance with the 1-month response deadline. Councils that repeatedly fail to meet it can be issued with formal reprimands. The right is enforceable, and the deadline is real. 30 years of council tax payments. A file that was opened the day you became liable and has been added to ever since. A legal right to see everything in it that has never once appeared on a bill, in a letter, or in any correspondence the council has sent. The single question costs nothing, and the response must arrive within the month. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That file is yours to request, and the deadline is fixed by law. But the next item on this list requires no request, and no deadline, and no data at all. And it applies to any pensioner who has been paying their bill a month at a time when a single decision made 30 years ago entitled them to pay it all at once for considerably less. Section 21. The lump sum refund. Every month for 30 years the payment went out. £200 or £250 or whatever the current rate was, adjusted upward each April, leaving the account on the 1st of the month or the 15th or whichever date the direct debit had been set to, and the total accumulated over those decades into a figure that sits somewhere between £30,000 and £60,000, depending on the band and the local authority and the year the payments began. Most of that money was correctly paid. Some of it was not, and the portion that was not correctly paid does not disappear into the council's general revenue in perpetuity. It sits in the account as a credit, waiting to be identified and claimed, and the mechanism for identifying and claiming it is not complicated and does not require a solicitor and does not require any fee paid to any third party, and the amount that comes back, when the process completes, arrives in a single transfer to the account the direct debit has been leaving for 30 years. The refund process for council tax overpayment works differently depending on what caused the overpayment. The most significant category, because it carries no limit on how far back it can reach, is the band-related refund. When a band challenge succeeds and the Valuation Office agency reduces a property's band, the correction applies retrospectively to the date the band was wrong. For a household that has been in a property since the council tax system launched on the 1st of April 1993, a successful challenge today produces a refund covering every year of that occupation. There is no 6-year limit. There is no 12-year limit. The refund runs from the date of error to the date the correction is made, and the only thing that determines how far it reaches is how long the household has been paying at the incorrect rate. The arithmetic on long-term overpayments is significant enough to make the claim worth calculating before deciding whether a challenge is worth pursuing. A single band error of £250 a year across 25 years of occupation produces a refund of £6,250 before accounting for the fact that the band rate has risen each April throughout that period, which means the actual total overpaid is higher than a flat calculation suggests. A two-band error across the same period doubles that figure. The money is not gone. It has been sitting in the wrong column of the account since the day the property was incorrectly banded, and a successful challenge moves it back. The second category of refund applies to discounts and disregards that should have been in place but were not. The single-person discount that should have started on the day a partner died but was not claimed for 2 years. The severely mentally impaired disregard that should have applied from the date of diagnosis but was never connected to the council tax account. The disabled band reduction that applied from the day the qualifying feature was installed in the property but was never applied for. Each of these generates an overpayment for the period between when the entitlement began and when it was eventually recognized, and each of those overpayments can be recovered as a credit or a refund once the underlying entitlement is established. The backdating limit on each one varies by type and by council and is worth checking specifically, but the principle is consistent. The entitlement ran from a date before the application was made, and the money paid between those two dates is the overpayment. Councils will not proactively tell you if your account is in credit. An account that has received a band correction and generated a substantial credit sits exactly as it was before the correction, with the credit waiting for someone to notice and request a refund. Most councils allow refunds to be paid directly to a bank account once requested. Some apply the credit to future installments instead, unless a direct payment is specifically requested. The request is made by contacting the council tax team, identifying the account, and asking for the credit balance to be paid directly. The process is administrative rather than legal and does not require any evidence beyond the account itself. The third-party firms that advertise council tax band challenge services and charge fees or percentages of refunds received are performing exactly the same steps available free of charge through the Valuation Office Agency and the council tax team. The neighbor comparison is free. The property attribute data request is free. The informal review submission is free. The formal proposal is free. The refund claim is free. Every step from identifying a potential overpayment to receiving the correction is available without any fee to any intermediary, and the refund that arrives at the end belongs entirely to the account holder, not in part to a company that submitted a form on their behalf. The payment went out every month for 30 years. The refund arrives once, and the calculation behind it is every month's worth of overpayment that can be demonstrated and documented from the records the council and the valuation office already hold. That refund calculation runs from the date of the error and returns the difference in a single payment once the correction is processed. But the next item is different from everything that has come before it, and it applies not to the bill on your kitchen table, but to a property you may have completely forgotten carries a council tax liability at all. Section 22. The second home premium. The property was not forgotten exactly. You knew it was there. You knew the council tax bill arrived for it every April, and that the direct debit covered it alongside the bill at your main address, and that the two payments left the account as reliably as everything else. What you may not have known, because the council did not write to explain it, and the annual bill did not announce it in any prominent way, is that from April 2025, the rules governing what you owe on that second property changed substantially, and that the change may have doubled the amount on the bill without any explanation of whether you had grounds to challenge it, and that the exemptions which protect against the new charges are nowhere on the bill itself and require a separate application that most affected households have never made. The Levelling Up and Regeneration Act 2023 gave local councils in England the power to charge 100% premium on properties classified as second homes, meaning the bill on a property not used as someone's main residence became 200% of the standard council tax charge from the 1st of April 2025 in the areas where councils adopted the power. Some councils implemented the premium immediately. Others did not adopt it at all. The position varies entirely by local authority, and the only way to establish whether the premium has been applied to a specific property is to read the bill closely or contact the council directly. A Band D property in a council that adopted the full premium in an area where the annual Band D rate sits at £2,400, now generates a bill of £4,800 a year. That increase arrived without any requirement on the council to notify affected owners in advance. The premium applies to furnished properties, not occupied as a main residence. The separate empty homes premium, which applies to unfurnished properties left unoccupied, runs on a different timeline, an additional 100% after 1 year of being empty, 200% after 5 years, and 300% after 10. These are different mechanisms operating simultaneously in the same system, and a property that has been sitting empty for longer than a year may be subject to a premium from either or both categories, depending on its status and the council's adopted policies. The exemptions from the second home premium were written into the regulations when the power was created, and several of them apply directly to pensioner households. A property where the owner is required to live elsewhere for work, known as a job-related dwelling, is exempt from the second home premium on the property used only occasionally. A property that is a self-contained annex forming part of the main dwelling, or treated as such for council tax purposes, is exempt. A property that has been actively marketed for sale for a period defined by the council's own policy may be protected from the premium during the marketing period. A property in major renovation or structural works may qualify for a Class A exemption, and a property that meets the holiday let thresholds covered in an earlier section of this list sits outside the council tax system entirely, and in the business rates system instead, where the premium does not apply. None of these exemptions apply automatically. Each one requires a notification or application to the council, and each one requires the owner to establish their eligibility with whatever evidence the council specifies. A pensioner who bought a cottage years before the premium existed and who has been paying council tax on it at the standard rate since then needs to identify whether the premium has been applied since April 2025, whether their property's circumstances qualify for any of the listed exemptions, and whether an application has been submitted. The bill that arrives for the second property shows the amount owed. It does not show whether a premium has been applied, what category of premium, whether an exemption has been considered, or what would be needed to remove it. The council tax system has always treated the second property separately from the main home. What changed in 2025 was the scale of what that separate treatment costs. A household that was managing a second property's council tax as a routine annual outgoing absorbed a doubling of that outgoing without any administrative process that required acknowledgement or agreement. The bill went out, the direct debit paid it, and the change was complete. Whether the property qualifies for an exemption, whether the holiday let classification applies, whether the annex exemption covers the situation, whether the renovation exemption removes the liability entirely while major works continue. Each of these is a question that sits unanswered in the system until someone asks it. The bill for the second property is on file somewhere. The exemption from it may also exist, and the application for it has never been made. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That premium can be challenged and in many cases removed entirely, and the application costs nothing. But the next item on this list requires no challenge and no exemption, and it applies to any pensioner who has been paying their council tax bill without ever once receiving confirmation in writing of exactly what they are paying for, and why every element of that figure is the amount it is. Section 23, the Ombudsman route. Every council has a complaints procedure. Most people who use it discover that the procedure consists of 2 stages, the first of which produces a response written by the department that got it wrong in the first place, and the second of which produces a response written by a slightly more senior person in the same department. The outcome of both stages is typically a confirmation of the original decision, worded more formally, and with references to the relevant legislation, and accompanied by a note explaining that if the complainant remains dissatisfied, they can contact the local government and social care ombudsman. Most people read that sentence, conclude that it describes a process too formal and too distant to be worth pursuing, and let the matter rest. The council has said no twice, and there is nowhere left to go. That conclusion is wrong, and the money that remains on the wrong side of it stays there, because the sentence at the bottom of the letter was never followed up. The local government and social care ombudsman is an independent statutory body that investigates complaints about local authorities, including complaints about how a council has administered a council tax account. The service is entirely free. You do not need a solicitor, and you do not need any legal knowledge, and you do not need to pay anything to anyone at any stage of the process. You submit a complaint, the Ombudsman's office assesses it, and if it decides to investigate, it does so independently of the council and produces a formal finding. If it finds fault, it recommends what the council should do to put things right, and it is extremely rare for a council not to comply with those recommendations. The boundary between what the Ombudsman can and cannot investigate in council tax matters is specific and worth understanding clearly. The Ombudsman cannot change a council tax band. That decision sits with the Valuation Office Agency, and appeals go to the Valuation Tribunal, not the Ombudsman. The Ombudsman also cannot decide whether you are liable for council tax or entitled to a particular exemption as a matter of law. What it can investigate is how the council went about handling your account. If the council gave you incorrect information about a discount you were entitled to, that is maladministration, and the Ombudsman can investigate it. If the council failed to respond to correspondence you sent notifying them of a change in circumstances, that is service failure, and the Ombudsman can investigate it. If the council sent enforcement letters to an incorrect address, took court action while a complaint was being processed, applied the wrong discount rate, or failed to tell you about your right of appeal after refusing a discount, all of these are the kind of administrative failings the Ombudsman exists to address. A documented case from Bolsover District Council in 2016 illustrates how the process works. A complainant's council tax correspondence had been going to the wrong address. The council then issued a court summons for non-payment without the complainant knowing, and also failed to inform him of his right to appeal a refused single-person discount. The Ombudsman found fault on both counts and recommended remedies for both. The council complied. The fact that the court summons had already been issued did not prevent the Ombudsman from finding fault in how that situation had been reached and recommending that the council put it right. The process requires you to have completed the council's own complaints procedure first. Most councils operate a two-stage process, with the first stage typically producing a response within 10 working days, and the second stage within 20. Once the council has issued its final response, you have 12 months from the date you realize something had gone wrong to take the complaint to the Ombudsman. The 12-month window runs from realization, not from the date of the original error, which is important in situations where a billing problem has been running for some time without the bill payer fully understanding what was wrong. The remedies the Ombudsman can recommend when it finds fault include correcting the council tax records, reissuing bills at the correct rate, applying backdated discounts or exemptions, and paying financial compensation for the distress and financial loss caused by the council's failings. That last category, compensation for distress and financial loss, is not negligible. The Ombudsman's own guidance on remedies addresses the question of how to quantify financial loss from council tax billing errors, and in cases where a pensioner has been incorrectly billed over an extended period as a direct result of the council's administrative failings, the recommended remedy has included both the overpayment and an additional payment, acknowledging the impact of the error on a vulnerable or elderly person. The second stage of the council's complaints procedure produces a letter that ends with a sentence about the Ombudsman. That sentence is not a formality, it is a door. That door is free to open, and the Ombudsman's recommendation, when it finds fault, is almost always followed. But the final two items on this list work differently from everything before them, and the next one requires no complaint and no investigation and no escalation at all, and it applies to any pensioner who has received a bill that they could not pay without difficulty and never asked a question that the council was required to take seriously the moment it arrived in writing. Section 24, the Vulnerability Declaration. It arrived with a reference number and a deadline and an implied finality, something owed, and something that would happen if it was not paid. And the person reading it at the kitchen table had not slept properly in several nights, and had already tried ringing the council twice, and waited on hold both times before hanging up, and felt, sitting there, that the whole weight of the machinery of local government was arranged against them, and that there was no lever left to pull. The council tax debt was real. The bill was genuinely unaffordable given the current circumstances, and the letter contained, as all such letters do, a sentence at the bottom about what would happen next if payment was not made, and it described enforcement agents, and the word bailiff was not used, but it was the word that arrived in the mind when you read enforcement agents, and the whole thing felt like something moving toward the house that could not be stopped. The letter that stops it is the one that has not been written yet. A formal written notification to the billing authority, sent by recorded delivery, declaring that the account holder is a vulnerable person and requesting that all enforcement action be suspended pending a review of their circumstances, is the instrument the council is required to take seriously the moment it receives it. Not a phone call, not a request made to whoever answered at the end of a hold queue. A written declaration, dated, addressed to the council tax department, stating the nature of the vulnerability, the reasons the current bill cannot be paid, and the specific request that enforcement action be paused while the situation is reviewed. The categories of vulnerability that councils recognize are broad and are not restricted to formal medical diagnoses. Age itself, in combination with the financial pressures of retirement, can constitute a vulnerability in the context of enforcement. A serious health condition qualifies. A recent bereavement qualifies. Mental health difficulties qualify. Caring responsibilities that leave no margin in the household budget qualify. The declaration does not require a doctor's letter or a formal assessment to be submitted with it, though supporting evidence strengthens the case. What it requires is that the council receives something in writing that places its enforcement decisions on a different footing than the automated reminder system that has been running up to this point. Once a council receives a written vulnerability notification, it is required to review the account with that information in mind before taking any further enforcement steps. The Ombudsman has found fault with councils that have continued enforcement against vulnerable people without giving them adequate time and opportunity to seek advice. The council's own vulnerable persons policy, which every council must have, sets out the circumstances in which enforcement will be paused and the account referred back from any enforcement agent already instructed. Some councils will recall a case from bailiffs entirely when vulnerability evidence is provided. Others will suspend enforcement at the point the declaration is received and offer a structured payment arrangement instead. The arithmetic of enforcement matters here. A liability order obtained at the magistrate's court allows the council to pass the account to enforcement agents. Those agents are permitted to charge fees on top of the original debt, a compliance stage fee of £75, which applies when the notice of enforcement is sent, and an enforcement stage fee of £235, which applies when an agent physically attends the premises. These fees accumulate on the account and become part of the debt. A pensioner who receives a notice of enforcement and does nothing because they do not know they can write a letter that pauses the process, pays those fees in addition to the original amount owed. A pensioner who writes the vulnerability declaration before the enforcement agent visits avoids the enforcement stage fee entirely and reopens a conversation with the council that should have happened before the liability order was applied for. The Citizens Advice Council Tax Protocol, which some councils have formally adopted, sets out specific commitments to engage with debtors early and to offer sustainable payment arrangements before escalating to enforcement. A council that has adopted the protocol and then used bailiffs against a vulnerable person without first attempting to establish a payment arrangement has acted in a way that the Ombudsman, if a complaint is made, would almost certainly find to be fault. The protocol's existence and the council's adoption of it, or failure to adopt it, is public information. The enforcement agent cannot force entry into a residential property to collect council tax debt. They cannot take goods if a child or a vulnerable person is alone at the premises. They cannot charge the enforcement stage fee if adequate opportunity was not given for the account holder to get advice before the visit. All of these protections are in legislation. None of them activate automatically. They activate when someone knows about them and uses them. The letter takes 10 minutes to write. The recording of delivery takes 3 minutes at the post office. The process it triggers is the one that should have happened before any notice of enforcement was ever sent. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That declaration turns the machinery around the moment it arrives. All 24 items on this list have been built from the same principle. The bill that arrives every April is not a fixed fact. It is a starting point, and the distance between where it starts and where it ends is measured entirely by what you know and what you ask. Section 25. The April letter. Every March the envelope arrived, or the email notification, and inside was the bill for the year ahead. The banned letter at the top, the annual total partway down, the monthly installment amount, and the date the first payment would leave the account. Most people looked at the total, registered whether it had gone up, and by how much, and filed it, or recycled it, or left it on the kitchen counter until it got covered by other things. The process took 2 minutes and produced no action, and the bill went into the system the same way it always had, producing the same monthly payment it had always produced. And April arrived, and the direct debit went out, and the whole arrangement continued as it had always continued. And the bill that had been the starting point of the whole year's council tax obligation was already somewhere under a pile of other papers, or gone entirely. That bill contained more information than most people extracted from it. The banned letter confirmed whether the drive-by valuation from 1991 had been accepted for another year without challenge. The discount status line, present or absent, showed whether any of the occupant-based reductions on this list were already in place, and which ones were not. The account balance showed whether any overpayment from previous years was sitting as a credit, unclaimed and unreturned. The total was the result of all of those figures combined, and none of them were as fixed as the printed number implied. Each one was adjustable by a process described somewhere in the previous 24 sections, and the adjustments available ranged from modest to the entire removal of the bill. The practice that makes everything on this list possible is the one that begins in March, when the envelope arrives. Reading the bill, reading it actually, not scanning the total and filing it. Looking at the banned letter and asking whether it has ever been formally reviewed. Looking at the discount status and asking whether it reflects the current household accurately. Looking at the account balance and asking whether any credit is sitting there unreturned. Looking at the annual total and asking whether any of the circumstances described across the last hour or so of listening apply to this household, this property, this person. The comprehensive written account review is the mechanism that formalizes that practice. It is a letter written to the council tax team at the billing authority, setting out the relevant circumstances of the household across each of the major categories: occupancy, disability, caring responsibilities, household income, property features, secondary properties, student status, age, and pension credit entitlement. The letter asks the council to confirm in writing whether any discount, disregard, exemption, or reduction is available that has not yet been applied. It does not require legal language, and it does not require specialist knowledge. It requires the writer to read back through the list and identify which items might apply, and note them, one by one, in the letter. The council, on receiving a letter of that kind, is in a different position from the council that has been billing a household on the basis of information it was given when the account was opened, and has never been asked to revisit. A council that fails to identify an available discount after a formal written account review request has been submitted has failed in its administrative duty in a way that is clearly documentable. The letter exists, the review was requested, the discount was not identified. If the Ombudsman later investigates, those 3 facts sit on the record. Most of the 24 items on this list were available from the day the circumstances that triggered them first existed. The single-person discount was available from the day the household became one adult. The severely mentally impaired disregard was available from the date of the diagnosis. The disabled band reduction was available from the date the qualifying feature was installed. The pension credit reduction was available from the day eligibility was established. In most cases, nobody claimed them because nobody was told they existed, and nobody thought to ask. The money that should have stayed in the household left it, month after month, year after year, and the bill that was the starting point of each of those years arrived in March and was filed without being read with any particular attention. The council tax system in this country has been running since April 1993. Every property assessed in that first year under the Local Government Finance Act 1992 has been generating a bill in the same format, in the same envelope, in the same annual rhythm, for more than 30 years. The bill that arrives this March is the same document that has been arriving since the system began. It has always said what it says. The question of whether it says the right thing is the one that most households have never formally asked. If you enjoyed this video, make sure to subscribe. Thanks for watching, and I'll see you in the next one.